How is everybody doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to get everybody an update on what's going on internationally. A lot of things have been happening in the world recently, and I wanted to take a look at kind of five different articles that basically look at what's going on with like Canada, Mexico, with trade tariffs, what's going on over in France with some of their banking issues, and then what's going on with Japan. And then finally, we're going to wrap up with a little China news, just to give everybody a little bit of flavor. I mean, again, most of what I cover on the channel is more domestic, kind of U.S. Banking news and what's going on in our economy, our financial markets, banking world, that kind of thing. So I did, like I said, from time to time, I like to keep tabs on what's going on internationally, just to kind of complete the full picture, let everybody know what's happening. So, so the first up is basically new tariffs on Canada, Mexico could add pressure to U.S. business and consumer costs. And this is from December 16th. And basically, it says here, President-elect Donald Trump's proposed 25% tariffs on all U.S. imports from Canada and Mexico could reshape trade dynamics in North America and increase costs in key industries, potentially squeezing businesses and consumers. Trump's tariff threats this year have placed every nation and import in the administration's crosshairs. However, Mexico and Canada account for nearly 30% of all U.S. imports and are leading suppliers of automotive goods, oil and gas, metals, plastics, and lumber. Tariffs could drive up costs for these key imports and for the finished goods they rely on these products as inputs, such as new housing, consumer durables, furniture, and machinery, according to experts. As a result, the specific proposal to tax imports from U.S.'s North American neighbors could discourage trade with its largest import sources and disrupt integrated supply chains for the automotive industry and other critical sectors. Mexico and Canada are two of the top automotive exports to the U.S., with nearly $160 billion of products shipped this year through October, according to S&P Global Market Intelligence data. So I think, a couple thoughts on that. Number one is, do I think a lot of those tariffs are ultimately going to get levied? No. But you also got to remember, it's a two-sided coin, right? There's the stuff that they're selling to us, but then there's also the stuff that we're trying to sell to them. And the problem is that, we're buying all this stuff from them and they're not really buying much from us. And that I think what you're trying to accomplish here, if you're I would like to think that any president would be trying to do this, you want to level the playing field, right? Like, you want to make sure that, they're buying an equal amount of things from us that we're buying from them, right? And you want to make sure that the companies here in the US that are trying to bolster sales, or that they're able to sell their product, there's a lot of companies that would like to do more business internationally. They would like to be able to sell their products in Canada or Mexico. And, and Mexico basically says, no, we're not going to allow the U.S. to sell their products in here, but we're going to sell all of our products and stuff, to the U.S. And so I think at the end of the day, I'm hoping that basically that all this is really going to do is it's not going to bring a whole bunch of new tariffs. And maybe it brings a couple here and there on certain things if Mexico and Canada don't want to play ball, so to speak. But I'm hoping that this basically gets worked out. It just creates a more even playing field, and this basically helps to bolster the sales of a lot of U.S. companies on the other side of this thing, get more sales going international to Mexico and Canada. But like I said, we shall see. Okay, next up, political turmoil clouds brighter outlook for French banks. The long-awaited upturn in French banks' fortunes faces headwinds from mounting political uncertainty following the fall of the country's government. France was plunged into political chaos on December 4th when the country's parliament voted to oust Prime Minister Michel Barnier after he attempted to force through an unpopular 2025 budget. French President Emmanuel Macron is now working to cobble together enough support from across the deeply divided French parliament for a new administration that can avoid a similar fate. The political instability comes as France's three largest banks, PNB Paribas, Credit Agricole, CASA, and Societe Generale forecast a turnaround in the performance of their domestic retail banks. Unlike most other European lenders, the recent rise in interest rates squeezed French banks' domestic lending income due to the peculiar features of their home market. The political instability is not translating into an economic crisis or recession yet, said Tom Theodore, independent bank analyst, in an interview with S&P Global Market Intelligence, but But if it does, the banks will suffer. The three lender stocks have largely trailed that of the S&P Europe BMI Banks Index since Macron announced snap parliamentary elections in June. Market intelligence data shows downward revisions to forecast the domestic lending income have also spooked equity investors. What do we know here? What do we do know is that basically this is an article from December 17th, and in the last couple of weeks, things have not improved. They've only fallen apart worse there. I think Macron's days are numbered as French president. I don't think he's going to be around much longer. You're going to have a new part. Again, there's all these squabbles in the parliament right now. So you have a very shifting landscape in France. What does that mean for their banks? Well, does that mean they're going to have this huge recession and all kinds of major problems? I don't know about all that, but I think the road might be a little bumpy for some of their banks for a little while until all this political turmoil basically settles down. I think France has basically, I have never really been a fan of Macron. And I think France has been a little overdue for a kind of like a course correction, if you will. So, Marie Le Pen, I don't know. I don't know a tremendous amount about her. I think that, I think there's potential there. She could do a lot of things that could potentially help the country, but I don't know. We'll have to see how that all plays out. But so it could be a little bit of a rough ride for the banks there over in France, and obviously other markets. There's obviously a lot of political turmoil right now in Romania, in Germany, and obviously UK. If anybody's been following any of that craziness that's been going on there, so a lot of stuff going to happen in Europe as it plays out this year. So what's going on in Japan? So Japan's monetary policy normalization to drive up credit costs for banks. So rising interest rates in Japan could drive up credit costs for banks and crimp lending if the central bank accelerates its policy normalization. So the Bank of Japan is expected to announce another rate increase as early as this month as the central bank moves forward away from its experiment with negative rates, which it abandoned in March with the first rate hike in nearly 17 years. The second rate hike in July took the benchmark interest rate to just 0.25%. Economists expect the rate to rise to 1% by 2026 based on inflation and economic growth numbers, and this at a time when the rest of the world looks at monetary policy easing. While higher rates can help boost negative interest margins at banks, they can also dent loan demand by driving up the cost for borrowers. The biggest challenge banks could face from higher rates would be credit cost, said Hideo Ashima, senior economist at Japanese Research Institute. One of the nation's three megabanks. Higher rates would pose the risk of cash-strapped companies falling into a worse funding environment. And you can see here just this chart's kind of funny because it makes it look like rates have really gone up where they just, just brought them up actually just a tiny little bit. But here's the bigger thing here. They don't really even talk about it in this article. So what happened, and I covered this last year in a couple of the things that I did, and that was basically that Japan had this whole thing called the carry trade, and Japan was the last country in the world to basically get to shift away from negative interest rates. And like I said, I covered this in a couple episodes last year, but in shifting by, 50 basis points, going back to 0 and then to 0.25, they dramatically affected this trade in their market called the Japanese carry trade. And basically the Bank of Japan, this whole thing almost blew up. And they dramatically backed off and basically said, okay, we're done raising rates. And things have kind of calmed down and this happened in like August of last year. So it's only been, 4 months or so since this whole thing happened. And the Bank of Japan basically said that they were dramatically backing off and they weren't going to do anything. However, fast forward, now all of a sudden it appears like they're back in, they want to increase rates and get rates back up. Now, why do you need to increase the rates back up? Well, you need to get them back up because if you have a problem, you need to give yourself some breathing room. If you have an economic recession, you need to be able to have some room to bring rates back down. And if rates are only at 0.25, obviously, if you bring rates back down, you're going back into negative territory again, which they don't want to do. So this is a major problem over in Japan. And also what's going on, they have basically, Japan's one of the largest buyers of our national debt, which they have basically dramatically slowed the buying of our national debt, mainly because they don't want the bonds, they want the dollars. But that's a whole nother, conversation. But I only point this out to basically say that there are big problems over there in Japan. So, okay, let's go on here. So what's happening with China? So here's an article from December 9th that basically says major Chinese banks log higher loan to deposit ratios as rate cuts hit. So loan deposit ratios at Chinese largest lenders climbed in the 9 months ended September 30th as interest rate cuts hit deposit growth. And then the second article here is basically from December 15th, and basically says mid-sized Chinese banks improve liquidity positions amid slow loan growth. So most mid-sized Chinese banks improved their liquidity positions in the 12 months ended September 30th amid a slowdown in low growth due to weak demand. As of the period, Bank of Chongqing had the highest liquidity leverage ratio among lenders in the Asia Pacific region, posting a year-over-year increase of 236 percentage points in its LCR to 511.75. So just like I said, just to give you an update. So we've got these mid-sized Chinese banks improve their liquidity positions. We've got major Chinese banks log higher loan to deposit ratios as the rate cuts hit. But here's a bigger thing. Let me just show you. This was something that was, there's some things that have been posted on X here. And I just want to show you that markets sound alarm over deflationary spiral in China. And this is, here it comes. So this was an article here that basically says markets sound alarm over deflationary spiral in China. Investors are increasingly concerned that China risks sliding into an economic malaise that could last for decades. China's 10 largest brokerages have all produced research on the neighboring country's lost decade in a sign of how seriously investors are taking the risk of Japanification. So obviously, Japan famously had the lost decade of production. But I've been reporting on this been talking about this for a while. I think, China has the largest real estate bubble the world has ever seen. And we've seen with Evergrande, a couple of the other, countries over there, Japan or China has a huge economic problem right now, huge economic problem. And, but China censors everything. They censor everything. They cover a lot of stuff up. So this stuff leaks out, but, it takes a little while. And, the question becomes, can you really trust a lot of the numbers that come out of China? I think that's to me is like the biggest question. That's why, I'm not big on investing in Chinese companies, because how do you really trust the numbers that you're really getting from these companies? I think that's a valid concern. So again, China, largest buyer of our national debt, they, like Japan, have not been buying our national debt, as again, just like Japan, they want the dollars, not the bonds. So you have you have big problems there that are relating back to our problems here with our national debt. In other words, we have to sell that debt, and our two biggest buyers aren't buying right now, or are definitely not buying as much. So okay. So I hope that gives basically just a little bit of flavor for kind of what's going on internationally. A lot of the political turmoil in Europe is going to lead to some banking turmoil, at least in the short run. We don't know what that's going to be. Japan and China continue to tackle with major economic issues within their particular economies. And then here, a little bit closer on the home front, we got the whole tariff issue with Mexico and Canada, and how's all that going to play out. So, but at least I hope this at least gives everybody a little bit of flavor for what's going on around the world right now. And I hope people find this stuff interesting, and we'll definitely cover and talk more about this stuff in future episodes. So with that, I will say, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always enjoy getting back to everybody. And finally, make sure to check out some of the other content on the channel, as I posted up what I think are some great episodes with a lot of really awesome information. So with that, I bid everyone a fond farewell, and I will see you all again real soon. Thanks a lot.